Welcome to Canadian Mortgage Weekly for Thursday, June 16th. We're joined here today with Sam Thompson, mortgage agent, and myself, Joe Bladek. We're running Canadian Mortgage Weekly a little bit different today, and we're really pumped today because we're getting into home equity lines of credit and all about how they work in 2022. Sam, I'm really excited. You're here today as well.
Yeah, we're live and in person.
Live and in person. I'm really pumped about it. We're no longer on Zoom separately, but together. Huge news for Canadian Mortgage Weekly. And this is episode 83. So welcome, guys. Yeah. So, I'm really excited about home equity lines of credit and what we have to talk about them. I know they've been really popular these last few months.
Yeah, absolutely. We have seen, a number of people reaching out and looking at, switching into a HELOC or opening one up with. I mean, I know that, again, we just had tax season, so a number of people, use it for tax purposes. But yeah, we definitely have seen interest in HELOCs now.
Yeah, and you know what? A lot of people do use them for other things like rental properties, debt consolidation. But let's just get into what we're going to talk about today, because we have a lot of points to cover. And one of the first things we're going to talk about is what is a home equity line of credit? You might be thinking, what is a HELOC? And that's exactly what it is, a home equity line of credit. It's an acronym, HELOC, and it's used to borrow money against your home, isn't it, Sam?
Yeah, absolutely. So compared to a typical line of credit, the rate does tend to be quite a bit lower because it's tied to the equity in your home. It's a secured loan rather than a typical line of credit. So we do see popularity in homeowners to choose a HELOC because they can still get that same loan, that line of credit that's usable. But again, because the equity's tied in, it is typically at a better rate.
Okay, yes, absolutely at a better rate. And also, compared to a credit card or it can be an even much better rate because compared to a personal line of credit, you're getting probably savings of about half, but compared to a credit card, you're getting huge savings.
Yeah, for sure.
Yeah. But one of the things, another thing that is really interesting about HELOCs is that it combines all that into a single payment. So it's almost like doing a refinance, but on your own in a way of a sense. But usually what you want to do is you want to really maintain that for an emergency fund or something like that, or something that you will use your home equity line of credit for as a tool towards something, but not a long-term purpose. It's more used to do things on a temporary basis, such as, say, putting a down payment on an investment property.
Yeah, that's right.
But then down the road, doing a BRRRR strategy on that investment property and then paying off that line of credit.
Yeah, exactly. Yeah, there's a lot of different uses for your home equity line of credit. And it's important to note that there is a maximum amount for the HELOC itself. It can't exceed 65% loan to value for your property. So if you wanted to do the math on that, getting your home value, which may be tricky to evaluate in today's market with the changes that we've been seeing, but the home equity line of credit can't exceed 65. So it's good to keep that in mind when you're planning or maybe forecasting the amount that you're hoping to get out in your HELOC.
Yeah, that's a good point, Sam. So 65%. So just to make the math easy, if you have a $1 million home, that would be up to a $650,000 limit on a, the maximum that you could qualify for on a home equity line of credit. That's providing if you have the income to qualify for that as well. Right. Yeah. And that's another thing too. We're noticing for home equity lines of credit that it is really hard to qualify for them. So if you feel like this is a product for you, at the end of the show, definitely give Sam, myself, or Terry Lynn a shout at the office so we can get you started to see how much you can qualify for on a line of credit. But moving on to the next thing, what about payments? I know that on a mortgage, you're paying back principal and interest at the same time. Typically, you have that payment done over 25 or 30 years. So Sam, can you tell us a little bit about how payments work on a home equity line of credit?
Yeah, of course. So the rate tied to a HELOC is, the rate for your HELOC is going to be a variable rate tied to the prime rate. So again,
Yeah.
it's another thing, if you've been tracking Canadian Mortgage Weekly and seeing what the prime rate has been up to, you'll have your discounted rate from the prime rate. And the good thing about HELOCs as well in terms of the payment is the fact that you pay on the amount that you're withdrawing from. So it can be, as little or as much as your approved maximum HELOC limit. It doesn't mean necessarily that, you're taking out 650,000. It just means that that's the limit you have. So the payments can vary based on what amount of that HELOC you've decided to use.
Yeah, that's huge too, because when we're talking with property investors, a lot of the time they're looking for a rental property and they want to have the down payment available, but they don't want to pay interest on the amount that they're carrying until they actually purchase that rental property and close on it. So a lot of the times they lose that line of credit, like you're saying, and not start really paying interest until they actually withdraw the funds from the line of credit, right? And on that, it's only a minimum payment of interest only, which is pretty good compared to a principal and interest payment. So the cash flow is preserved in the situation that you are needing those funds for that temporary period of time. Obviously not a good idea to carry that balance long term, because you're only paying interest every month. And the only person that's going to be happy about that is the bank. So we want to make sure you're happy as well. So let's get that going. Looking at the next thing is that there's also different terms for home equity lines of credit. I know on a mortgage, there's 1, 2, 3, 4, 5-year terms, 10-year terms. We also have things like variable terms, fixed terms. But a home equity line of credit is a little different, right, Sam? I mean, there's not really a fixed mortgage term for a line of credit.
Yeah, exactly. It's just the sort of repayment window that, again, you want to set up. And it's important to note that some lenders do have minimum amounts. So if you are looking for maybe a very small amount to just cover off a really cheap reno or something very quick, it is important to note that some lenders, not all of them, do have a minimum, typically around 10,000. But again, we do have lenders that there is no minimum. So that's something to consider, again, when you're having that conversation with your mortgage professional, setting up the ones that are right for you.
That's right. That's an interesting point. And as we're talking about the limits on lines of credit, I'm reminded that even some lenders, they not necessarily have limits, but they have stages in which if you qualify for a line of credit, say between 0 and 50,000, you'll get a certain interest rate, but then from 50,000 and above, the interest rate might be higher or lower depending on the lender, and it could be better because you're qualifying for more. And there's those little things as well. So you want to make sure you're dealing with the right broker, the right agent that knows those products and that can set you up with the perfect product, with the limit you need, with the bank you need, with the proper documentation that you have, and matches it all together for what your goals are. Just looking at the next part here, HELOC or refinance. Something that we were talking about earlier, how a HELOC can be used as a refinance vehicle, but really it's not a long-term refinance vehicle because it is an interest-only payment.
Yes. Yeah. So there's a number of differences, and I think you brought up a good point that is on a lot of clients' mind when they're looking at getting a HELOC, and that's that they're not carrying the interest payments before they actually need the funds. So again, we do see it in a lot of cases where the client is looking to use that money, but maybe it's a little bit further down the road. Whereas if you took that refinance, your payments start on your next cycle, as your terms are set up for that refinance, and you're paying that amount in interest right out the gate, compared to a home equity line of credit where you get approved for the limit and then you can use those funds right and directly as you need them.
That's right. And that's all good points. So it all depends on what your goals are, really.
Yeah.
If your goal is cash flow and preserving that and having flexibility, then maybe a line of credit for the time being could be good. Refinance, you want to make sure you pay off the loan in a certain amount of time. You want to have a schedule. You want to have it on track for a certain target and actually paying on principal. Then you want to look at a refinance, or maybe both is in the cards and just using one and then the other is the way to do it. the important thing is that Sam and I want to be able to share this information with you so we can educate you and provide you with some information to help you make an informed decision with your mortgage products in 2022. And as we cover mortgage products on Canadian Mortgage Weekly, Canada's only weekly video mortgage news podcast for the Canadian homeowner, we want to make sure that we are giving you as much information about home equity lines of credit that you can digest, so you can take that and either go to your own bank and set that up, or contact us and we can set you up with a line of credit through a bank that can offer the best solution for what your goals are. I know that we work with a number of different lenders, Sam, Terry Lynn, and I, to make sure that we complete those lines of credits for you. And it's always a great opportunity to look into what solutions are available for yourself. Now, last thing is the costs to set up a line of credit. Now we've talked about all the good stuff. Let's look at how much it does cost to set that up.
That's right.
So it doesn't cost, like the bank's not really going to cover the fees for you to set up a line of credit in this case. A lot of the times, if you already have the mortgage set up with that bank, then the bank will ask you to pay legal fees, and appraisal is necessary, really necessary these days as well.
That's right.
With the way the market's been. It's also a mortgage penalty if we need to switch lenders, and a mortgage lender fee, which can be sometimes an intrusive but needed aspect for those files that are, more on the alternative side. We see a lot of self-employed people there, maybe those with poor credit but still want a line of credit.
Yeah, exactly. It's all, there's many different aspects depending on the client and as well as the client's needs. Again, as you were saying, sometimes, even qualifying for a HELOC can be difficult, but it can be maybe a bit easier on the alternative side where they're a bit more lenient in ways that, a prime A-lender bank might be a bit more strict on some of their policies.
Exactly. That's a good point. If you find that you've applied for a line of credit and you're not satisfied with the limit that the bank's giving you, and you're thinking my income and based on my credit, I should be qualifying for much more, then it might be that you're just dealing with the wrong bank or the wrong professional that doesn't have access to the same products that we have. A lot of the times, Sam, you and I will work on a file and we'll see maybe they qualify for 30, 40,000 from lender A, then maybe from lender B will be 150,000.
Yeah, that's right.
Frequently happens, right? Anyway, that's enough about line of credits for 2022. We'll now get into some of the mortgage statistics that we'd love to get into here on Canadian Mortgage Weekly. Because we're broadcasting from Aurelia today and doing it a little bit of a different strategy to broadcast, what I'll do is I'll share this screen here and we'll get this rolling because we have a lot of interesting statistics to share with you today.
We do. Our typical metrics have been very busy. So we have lots of updates to cover in the news portion of today's episode of Canadian Mortgage Weekly. I'm sure that many of you guys have been, tracking and seeing even just articles of, what the market has been up to. And again, some of those statistics, looking at the economy, at rates. So again, it's important when we're seeing lots of these changes in rates to make sure that we know the factors that are involved in the changes that we're noticing in the rates, and be able to give a bit of insight of also maybe where we think where the mortgage rates are going to be headed. Yeah,
it's hopefully we can get some insight from the statistics today so we can give our viewers some good data as to what to expect going forward. Looking at this slide here, episode 83, I can't believe that.
83, that's right.
Yeah. Well, looking at what we have here, first thing we have is the bond yield. I know that's been creeping up pretty quickly.
Yes, the bond yield has had yet another surge. I think the last time we reported last week, it was about 3.19%, which is probably somewhere, at the bottom of that pretty steep incline. And now we're seeing it sitting at 3.49, which, it's bond yield rates that we haven't seen in the last almost 14 years.
Yeah.
So again, something very important to track as we, see the effect that it's been having on the typical standard 5-year fixed rate.
Yeah, really, it has been having a very profound effect. And I'm just looking at this graph here with you. just let's take a look at this. We saw last year the rates were down here, were pretty low. Then we saw the rates going up slowly in the fall and then quite accelerating in the spring. And now we have this additional acceleration here, which leads me to believe, that rates will probably head up. Like looking at this graph, they may head up continuously for the next little while based on this graph. And I know we've been seeing 5-year fixed rates break that 5% barrier.
Yeah.
We did a video yesterday about 5-year fixed rates breaking the 5.5% barrier.
Yeah.
So just to know where all that's headed now, perhaps we will see rates hit 6%.
We could. I mean, if you track the trend line over the last little bit, it has been quite steep. It may have the potential to level off a bit, but I mean, yeah, I definitely still think that high rates are in the future, and that bond yield isn't going, as steeply down as we saw it increase in the last week.
That's right. And it's interesting. We were talking about when it did go down here to say we were thinking about what was going to happen in the future, but it just ended up going down and then shot right back up. And that's a similar strategy to what happened down here when it went down and then back up, and then a little bit of the same here, down and then back up. I'm no professional chart reader, but I'm seeing a pattern here.
Yeah.
So yeah, we'll keep in touch with this. I know inflation, we have it at a 40-year high now.
Yeah.
So I know the Bank of Canada is pretty serious on making sure they get that in check, but they also don't want to cripple the housing market. So we'll have to see how this all works together. CDOR rate. I know this is a fantastic data point we track here on Canadian Mortgage Weekly, and we're at 1.97% today, or 1.927%.
Yeah, so it has gone up slightly from last week when we reported it. But when we look at its variance from the prime rate, it is still under 2%. So it does indicate that the variable rate option is still a good option, given, again, we've been seeing lots of articles about what the Bank of Canada has been up to. We've seen a few rate hikes in the last number of months. But again, comparing directly that CDOR and variable rate to the fixed rate,
that's
it's
right,
still indicating that variable is a good option.
It really is. Yeah, we're seeing continually people ask about variable rate mortgages when presented with fixed and variable rate mortgages. A lot of folks do prefer the variable for the fact that it does give them a better cash flow position right now. And with some variable rate products, they are able to lock in those payments. So it's just the amortization that is changing and not the payments. So yeah, it's a great way to pay less on your mortgage right now. And locking in does preserve those payments going forward. However, it is a high cost if rates do go down in the future.
Yeah, that's right.
Yeah. All right, Bank of Canada announcement. I know we have that coming up.
Yeah, so the next Bank of Canada rate announcement is July 13th, I believe. The last rate announcement we had seen was an increase of another 50 basis points, making the overnight rate 1.5%. So yeah, the last rate announcement and hike was the third back-to-back, supersized rate hike. And yeah, you can check out last week's video where, when we covered that rate announcement live and went through a little bit in more detail, the articles leading up, the sentiment leading up. But it'll be interesting to see what the Bank of Canada does at its next rate announcement, given some things that we've seen south of the border.
That's right. Exactly. Good point. And I know that the 13th is not too far away at this point. I think we're looking at just around a month away. And what's happening south of the border? Yes, yesterday they raised the rates in the United States. South of the border there, the Fed raised by 0.75%, so 0.75. And that is the biggest rate hike that we've seen in the United States since 1994.
Wow.
Yeah, so a good time for music in 1994, I would say. Not a good time for interest rates.
Right.
But talking about 1994, I know the housing market was in a different position completely. I think grunge was coming in terms of music. Alternative was big. So it was a good time for music, most definitely, but not a good time for the housing market. So we'll have to see what happens with rates going forward. We'll really make sure we follow the Bank of Canada interest rate announcement on July 13th. I know there's been a few articles saying that the Bank of Canada was too slow in implementing these rate hikes, and that's why this is happening so quickly, so fiercely and aggressively now. But we also have seen that maybe this is too much, but also maybe this is not enough. So there's all these different articles we're seeing out there.
Yeah,
it's going to be interesting to see what happens.
Exactly, and it is the rate announcement as well as the monetary policy, which is always important. When we're seeing lots of articles, and you guys, I'm sure, as well as clients, are seeing these articles as well, and some of them are coming from very different viewpoints. So seeing that monetary policy will help, clarify exactly where the Bank of Canada is at.
Yeah. And I think that another big consideration will be the average national home price.
Yeah.
And what's been happening with that because of the rate hikes. And I'm not sure if you can see that, all the viewers out there, but when the Bank of Canada did announce they're raising rates in January and followed through on that, we had a coincidental drop in housing prices from January on. And we can see this drop has continued into this month by the looks of it, Sam.
Yeah, it has. We have seen, I believe our previous high in February was about 816,000, and the current data that was just released for May of this year has the national house price average sitting at $711,000, which is quite a substantial change to see over such a short window.
A huge substantial change, and it presents a lot of opportunity out there for the Canadian home buyer. These are prices that we really haven't seen here since I think like last year at this point.
Yeah, exactly.
So if you're looking to get into the market at last year's home prices, this is a great opportunity. You may have felt like you missed the boat last year. Well, at this point, house prices have come down. The caveat is that although they have come down, rates have gone up.
That's right.
And that's made the payments, unfortunately, more expensive than when houses were priced higher.
Yeah, that's right.
So we'll have to see how this all works out and how the housing market takes it going forward. But prices are low now. I think a great way to capitalize on a market that would increase in the future with rates going down in the future, if that was to come to fruition, Sam, would be to take a variable rate now and to either refinance into a better variable or a fixed rate if it drops in the future, to lower your payments further.
Yeah, exactly. That's a really good strategy because, again, going with that variable rate, there's a significantly smaller penalty to refinance if that's what your aim is, or again, like Joe's saying, locking in if we do see these fixed rates start to drop.
Yeah. Well, great conversation today, Sam. I know it's always great chatting about this national house price average and what happens here on what happens with these statistics here in Canadian Mortgage Weekly. It's always great having you on the show as well, Sam. You come with 2.5 years experience, almost 2.5 years experience in the mortgage industry, originally from Ottawa, Ontario, lives in Barrie, his wife and dog. Great having you on here, Sam. And he even plays guitar. So with the rates come back to 1994, we'll have to start breaking out the guitar soon, playing some songs from the 90s.
Start a grunge band.
Yeah, well, it'll be in perfect timing with all these rates and the announcements that's happening. It feels like we're in the 90s again.
Yeah, to break out the flannels and see where that goes.
Yeah, that's right. Yeah, well, it's great having you on the show today, Sam. And next week, I'm looking forward to episode 84. What do we have going for next week?
Yeah, next week's episode 84 is going to be all about reverse mortgages. So again, this is a interesting process and a lot of different things to consider and different options to consider. I know sometimes reverse mortgages do have a bit of a negative tone to them, but check in next week and we'll have a bit of full coverage on what is involved in a reverse mortgage and the types of products that are available for you.
Yeah, absolutely, Sam. Thanks very much for that. And in the meantime, we hope you have a great day. If you have any comments or questions, maybe you'd like to suggest a topic for Canadian Mortgage Weekly where we cover it live and you can ask us questions, feel free to leave a comment below. If you like what you're watching, share the video so we can get this out to more folks and share this information with all of you. And yeah, thanks for joining us for episode 83 of Canadian Mortgage Weekly, Canada's only video mortgage news podcast. And we'll see you guys next time.